got Martin Crabb here. It's a Tuesday. You can set your clock by it from Shaw and Partners. He's the CIO to wrap things up. So is this classic dip buying in some of these very beaten down names?
It seems to be. I mean, if you were born at 10:30 this morning, you've only been in a bull market, right? So it's a glass half full thing. So yeah, interesting. We were watching Xero and it was down 3% on the open. I think WiseTech rallied something like $6 or $7 off its lows, but it was around the region as well. It was not just Aussie, but Korea, Taiwan, China, Hong Kong, all those markets caught a bid. And interestingly, it was in growth names, as Kyle said. It's long duration stocks. So maybe there's a feeling that we're at peak Fed. Neel Kashkari is probably the last dove on the Federal Reserve Board. He's turned hawkish. So we got the CPI print this week. That's going to be peak inflation. Maybe we've still got peak Fed. Maybe we've got peak bond rates. So the price action today was people buying long duration stocks and selling miners, which are the ultimate short duration stocks. So there is a trade out there that was played out pretty massively in our market, but probably more broadly around the region, which is to say, right, this is the peak in long-term interest rates. So I'm going to move out of my commodities and cyclicals. I'm going to move into some long duration, IDP, education, Domino's. It wasn't just tech. It was all growth names.
Interesting. So I mean, given the broader backdrop, and I suppose moving past just the intraday price action, do you think this amounts nothing more perhaps just to a bear market rally? Or do you think there could be a genuine turning point here for investors?
Yeah, it's tough. I mean, I follow quite a few macro people, and there's a few people saying, you know, it's time to move away from the super defensive positioning that everyone's had this year and start to put maturity or duration back into portfolios, because a lot of people have had zero or even negative duration. So I just don't want to be there when bond yields are going up, and now I think they've topped. I need to go back to neutral. So not necessarily getting super bullish about things, but just taking off a negative bet. So personally, I think we've got further to go. We've only just started central bank hiking, and we've still got tightening financial conditions. Mortgage rates are still going up, and we've still got slowing growth. And obviously with China in lockdown and Europe stuck in a war, that's not going away anytime soon. So I think although it's tempting when you get these big sell-offs to go and put money in the market, I'm a dry powder kind of guy, so I'm going to sit on my hands for a bit longer.
Because we do have this inflation read to come. I mean, most are expecting inflation to start to wane from here, but given the broader environment, I mean, who knows? You brought a chart in with you talking about the US 5-year implied inflation up by about 3.26%.
Yeah.
What indications, if any, do you have that would help you inform your view that perhaps inflation has peaked?
Yeah, so how aggressively the Fed is going to tighten. So the market's got, you know, Fed funds pricing going to 3.5%, maybe even higher, up to 3.75%. And that's going to cause a recession if they do that, because there's just so much debt out there. So we just see this 5-year implied inflation. So these come from the TIPS market, the Treasury Inflation Protected Securities. So they're like inflation-linked bonds. So if you take the yield on those and the yield on the government bond, you can work out what the market's implying for inflation. And you can see that we had sort of deflation in the COVID sell-off, and it's been going up, and that's a 5-year number. But that seemed to have peaked a few weeks ago, and as the Feds become more hawkish, i.e. they're going to put rates up faster, the market said, well, if they do that, they're going to control inflation. They're going to get the growth rate down. But the longer term number, the second 5 years, so there's 5 years, that's been creeping up, saying that inflation is not transitory, it's starting to build. So with just that orange line there, that's a sign to investors that inflationary expectations have peaked. And if that's the case, maybe bond yields have peaked, and hence the adding duration to your portfolio.
Certainly. I mean, I've asked this of a couple of guests actually, because I think it's a real theme at the moment, because we have seen a real high correlation between stocks and bonds, haven't we, in terms of, you know, we're not getting that kind of defensive protection from fixed income. No. Is it sort of the end of the risk parity trade because of this regime change, or is it simply the fact of just waiting for inflation pressures to settle down and then we can get back to more normal correlations?
Yeah, so risk parity is made famous by Ray Dalio at Bridgewater, and he tested it during periods where there wasn't stagflation. So typically what happens is when growth slows, inflation comes down and bond yields rally. So when growth's slowing, you buy bonds and you do well. We've got slowing growth and the bond market's getting absolutely destroyed, right? The Bloomberg global aggregate is down 15% from its high. So hang on, we've got slowing growth and yet bond markets are going backwards. It's because we've got a stagflation. So risk parity models don't do particularly well. In fact, a lot of macro trending models don't do very well in stagflation, because stagflation is not supposed to happen, right? You either get You either get high growth and high inflation or low growth and no inflation. You don't get low growth, high inflation. We've only ever had that in the 70s. And I was still in shorts. I mean, I've got a few years on me, but I don't remember what stagflation was like, and very few people do. So I think that's probably what that comes back to, Kyle.
In that sort of environment, then, if I may sort of expand on that a little bit, is where do you get the diversification? Where do you allocate in a stagflationary environment, possibly?
Well, you need a mix of inflation hedges and things that do well when the economy is slowing. So pricing power is a good one. So not necessarily technology stocks, because they're getting hit by the growth slowdown, but your defensive stocks that have pricing power that will survive inflationary environment. So if you look at one of the best performing stocks in Australia, it's Amcor. It's up 16 to 17% in the past month and a half, because it's perceived as defensive, so you want to own it, and it's got pricing power. So it can pass on higher resin prices, higher paper prices, etc. Transurban's doing well, APA, so you're looking at those defensive companies with pricing power. And the other thing is what's causing the inflation, and we've been banging on about energy, right? So if the situation in the Ukraine doesn't resolve itself, and it doesn't look like it's going to, you take the Russian oil out of the market with short oil, no one's investing in it, the price is going to keep going up and causing more inflation, so therefore it's the poison and the cure for your portfolio. So I think between energy pricing power and then obviously owning floating rate debt rather than fixed rate debt.
What do you think of the telcos?
Yeah, they sort of fit into that basket. I mean, we always laugh about Telstra having the worst customer service of any company in the world, but it's got a fantastic network. So if you really want dependability and a reliable network, you kind of go with Telstra, notwithstanding the customer service could be improved. And so it's theoretically a defensive. We're all going to use our phones even if the economy's a bit slower, and they do have pricing power. So if Telstra all of a sudden, has to pay more wages or pay more for materials, they can just put their network prices up, because most of Telstra customers, and I'm one, will just pay the extra 5 or 10% because we like the service that we're getting in terms of the network.
Yeah.
Wage price spirals I was going to ask about, because we do have another chart here, I believe, just in terms of the US labour market and job openings, if I'm not mistaken.
Which are massive.
Yeah.
It's a societal problem.
Yeah, they've got almost 12 million job vacancies and 5 million unemployed people. So, or maybe 6 million unemployed people. So I think the ratio, so you can see there the orange line is unemployment. Obviously it's shot through the roof during COVID where everyone was laid off. But since then we've now got less unemployed people than we had pre-COVID. And you can see job ads have gone from 5 million to 11 million. And just the correlation between job openings and wages, we expect wages will continue to push higher because you're fighting for a limited resource. So unless the US opens its borders tomorrow and brings in another 5 or 6 million people, they're short workers. So I think that's going to happen. Australia is difficult to see this happening just because decentralised wage fixation and no one's in a union and people don't feel they've got the bargaining power that maybe they do. So you've almost got a threaten to resign to get a pay rise, which people aren't comfortable doing. So we haven't really seen a lot of wage pressure in the official statistics. We're seeing it if people change jobs, they're getting pay rises, but if you're not changing jobs, getting a pay rise from your boss is increasingly difficult.
Yeah, completely different landscape here. Okay, so sum it up. We are obviously still waiting for the US inflationary data, which will be an inflection point in some way, shape, or form. Markets will either rally or they will do the opposite, which is a day-to-day proposition. So what do you do? What is the investment strategy right now, Martin? Holding on to that cash, waiting for further falls, or what? Yeah,
look, it's tempting on days like today to have a nibble at a few things because, especially in the small and mid caps, some stocks have been absolutely belted, and yet the fundamentals haven't really deteriorated, so they're just getting cheaper. But we still stick with the view that until conditions change, we're not going to change our strategy. And conditions we look at, what are central banks doing? They're all tightening. What are financial conditions doing? They're becoming tighter. Governments are taking bonds out of the market and mortgage rates are going up faster than the cash rate. And what's growth doing? And growth's still continuing to slow. So, and we really can't see that turning around. I mean, unless China, abandons its zero COVID policy and starts a massive stimulus package next week, which they may do, that'd be a sign to get back in. But while these conditions are the way they are, we just stay defensive. And if and when they change, then you can start putting your money to work. But we're in a market to be defensive, not aggressive. Okay, and just finally tonight we've got the FOMC's Williams,
Barkin, Waller, Kashkari, there you go, the former Dove,
Yeah.
turned hawk, Mester, all speaking. Clearly Williams and Waller might be the main focus because they're permanent FOMC members and voters, I should say, as well. Do you wake up and hang on every word these guys say?
No, I just I try to listen to the press conference if there's a press conference, and I'll read the notes. But generally, I'll rely on people like Ausbiz to do the analysis.
Thank you.
Me.
But also, I mean, they're not going to say anything that deviates from the songbook. You wouldn't think, would they?
No, look, I think they're all just saying, look, it's inflation. We're not worried about the labour market. We're not worried about the economy. That's all fine. We've got to stop inflation, and everyone's going to sing from the same song sheet.